agreement. So reverse repo is a reverse repurchase agreement, and this agreement works between commercial banks and the central bank of a country. And by this time, all of you know repo rate is the rate at which a commercial bank makes a short-term borrowing from RBI. Now, for this borrowing, some collateral needs to be kept with RBI, and that is in form of GSECs, which is government securities, or T-bills, which is treasury bills. So now these securities are kept as a collateral with RBI for this borrowing, with the intention of repurchasing them after a certain point of time, which is generally 1 day, but it can extend further also, at the repo rate fixed by RBI. So that becomes the lending rate which has been fixed by RBI, and by payment of that interest, you can, with the principal amount, you can repurchase back your securities. So in the example you are given, say let us assume the repo rate fixed by RBI is 4%, which it is right now, and the amount borrowed by a bank from RBI is rupees 10,000. Now, when the bank approaches the RBI for loan, it will keep certain securities with RBI, and RBI will give an amount of rupees 10,000 to the bank. Now, when the purpose is for the duration of the agreement comes to an end, the bank will go back to RBI, will pay 10,000 principal along with 400 rupees of interest. And this repurchase agreement comes to an end once the securities are transferred back to the commercial bank. Now, the repo rate in India is fixed and monitored by the central banking institution, the RBI. All of you know it is an integral part of the monetary policy which is announced by RBI, and repo and reverse repo rate are actually part of the liquidity adjustment facility. That is, they both these instruments are used to control the flow of liquidity, flow of money supply in an economy. Okay, so in other words, repo rate is simply the rate at which RBI is lending to commercial banks when they are facing some financial crunch or financial uncertainty. Now, coming to reverse repo rate, again a related term, it is a reverse repurchase agreement. So you can say, yes, it is the rate at which RBI borrows from commercial banks, or it can also be interpreted as the rate at which the commercial banks, they are parking their surplus funds with RBI. I repeat myself, you can interpret reverse repo in two ways. One is that this is the rate at which RBI is borrowing from the commercial banks, or commercial banks with surplus funds. They don't want to take the risk of lending these surplus funds above the policy rate. Say they are having surplus funds and they don't want to take the risk of lending them to other banks or individuals or financial institutions, and they deem it to be more fit that they lend this money to RBI because that is a safer option for the bank and earn some interest on it. So commercial banks with surplus funds, they park these surplus funds with RBI at the reverse repo rate. So this is the rate which is earned by the depositing bank. So now the commercial bank is earning interest on this deposit made with RBI. For example, if the reverse repo rate, which it is right now at 3.35% per annum, the amount deposited by commercial bank into RBI's account is rupees 10,000. Now this interest rate will be earned. Sorry, I think the amount I have not corrected. The interest rate that will be earned by the commercial bank once the reverse repurchase agreement comes to an end will be rupees 335 if the lending or if the deposit has been made for one complete year. Okay, so the interest rate earned will be rupees 335 as per the current reverse repo rate per annum. Now, the reverse repo rate again controls the money supply in the economy. Now, when the government, not the government, but say when the RBI feels that there is excess liquidity in the system, that is, it wants to tighten the money supply, it will increase the repo and reverse repo rate because that will discourage the firms, discourage the banks. If I specifically talk about the repo rate, whenever money supply is excess in the economy and the RBI feels that the lending part should be controlled, the lending part of the banks should be controlled, it will increase the repo rate so that banks are able to borrow less from RBI and subsequently lend less in the market. Similar is the case for reverse repo. But what reverse repo is doing, it is offering interest. It is offering some return to the commercial banks. So this is one of the ways in which the RBI is absorbing liquidity. In the sense, if you increase the reverse repo rate, commercial banks will be more motivated to deposit funds with RBI. So you are again controlling the money supply in the economy. The basic purpose behind both the rates is liquidity adjustment in the economy, but repo is used to inject liquidity while reverse repo is absorbing the liquidity from the banks. Coming to the difference between the two, what I have explained you can be summarized in this representation. So through repo rate, there is injection of liquidity because RBI is lending to banks and then banks can lend to the customer, to the institutions in the market. So liquidity is moving from RBI to commercial bank, which is giving a collateral of government securities, keeping a collateral of government securities with RBI. On the other hand, when reverse repo is used as an instrument, it is done for the purpose of absorption of liquidity, and now the funds are moving from bank with RBI. So liquidity is actually moving in the opposite direction. RBI is getting more funds, liquidity, and that is falling in case of commercial banks. They have less to lend to the market now. So the difference in tabular form is presented on your screen. Repo rate is generally and is always kept higher than the reverse repo rate. Now, repo rate is used to control inflation per se, while money supply is controlled by reverse repo, though both of them are actually controlling the liquidity flow in the economy. While repo is to fulfill the deficiency of funds, reverse repo is ensuring liquidity in the economy. Apart from that, there are some other differences. If you increase repo rate, you make loans more expensive, while if you increase reverse repo rate, you are decreasing the money supply by encouraging commercial banks to keep their funds with RBI. Any of the points in the difference which requires further explanation, please have a look. Okay, then we move further if there's no question. Okay, now we come to two institutions which have a very important role in the money market. One is DFHI and second is STCI, starting with the Discount and Finance House of India. So both these institutions which I talk about are actually were actually institutionalized, incorporated with the purpose of providing an active secondary market in the money market segment of the financial system. Now, DFHI was formed under the supervision of RBI jointly with public sector banks and financial institutions, formed in 88 and commenced its operation in the same year in April. Now, the main objective, as I told you, is to develop an active secondary market to facilitate the smoothing of short term liquidity, because that is what the money market is doing. Now, DFHI acts as a market maker. मार्केट मेकर का मतलब क्या हुआ कि बोथ डिमांड साइड एंड सप्लाई साइड से पार्टिसिपेट करता है ये इंस्टीट्यूशन, एक्ट्स एज बोथ बायर एंड सेलर इन द कॉल मनी मार्केट, नोटिस टर्म मनी मार्केट, टी बिल मार्केट, commercial bills, CDs, certificate of deposit, and CPs, commercial papers. Now, on daily basis, it is quoting a bid rate, which is the buying rate, and an ask rate, which is the selling rate. So, participating at both ends and hence providing liquidity, increasing the activity in the secondary market. Now, what was the purpose of incorporating DFHI? To bring equilibrium of liquidity in the Indian banking system, to impart liquidity to the secondary segment of the market. It is also a primary dealer. So, authorized registered participant to deal in government securities. And now the new name of DFHI is SBI DFHI, after SBI has acquired a major portion in this institution. Now, role of DFHI in the money market. Now, it is dealing in 91 days and 364 days T bill. These bills are, as I told you in yesterday's class, they are auctioned. The details of the auction are released through circulars which are uploaded on the RBI website. The day of starting of the auction and the day of redemption of the T bill is mentioned in the details related to the auction. And then your banks, financial institutions can place their bids through the negotiated dealing system, which is the online software, online system through which orders are placed and settled. Now treasury bills are generally are sold at fortnightly auctions, and they are not bought back by RBI before maturity. So once a T bill is issued, it can be returned back to RBI only at the expiry of the duration. But now, if that particular commercial bank which has bought the T bill needs any funds by keeping T bills as collateral during this duration, within this duration, then DFHI can be a prospective buyer. I repeat myself. Say commercial bank, say Axis Bank, to meet the statutory liquidity requirements has bought T bills, treasury bills from RBI. Now this is a 91-day bill. Okay, so which means if issued today in February, after 3 months, this T bill will be returned to RBI, and you will get, because it has been issued at discount, it will be redeemed at par, and that becomes the return on the investment made. Now, if within this 3 months duration, Axis Bank needs money, and for that it is ready to keep these T bills as collateral, RBI is not going to entertain Axis Bank, because RBI will redeem or will take back the T bills only at the expiry of these 91 days. So now Axis, to meet the short term liquidity requirements, short term fund requirements, can approach DFHI, which is on daily basis giving the buying and selling rates for treasury bills. So any facility like this will give more liquidity to the secondary segment of the money market. And DFHI is not only buying these bills, it is actually selling these bills in the secondary market also. Then second is rediscounting of short-term commercial bills. Again, rediscounting as a term was discussed yesterday in the class, that once the buyer and seller enter into a transaction, acknowledgement of this debt can be done properly legally through a bill of exchange. Now this bill of exchange will be encashed by the seller only at the expiry of the duration mentioned. Now again, if in this duration the seller needs some money, buyer is not going to entertain that. So the seller can approach a commercial bank and get the bill discounted. Now this bill can be further rediscounted by the commercial bank, and one of the authorized parties for rediscounting of commercial bills is DFHI. Again, for this purpose also, It is offering the buying and selling rate on fortnightly basis. Then third point is call money market and term deposit. So it is rendering the services to banks by access funds or providing funds to commercial banks. Another institution which was incorporated to encourage or to develop the secondary segment of money market is STCI, established by RBI in 1994, that is after DFHI, and RBI is the major shareholder, was the major shareholder with 50%, more than 50% holding. But today, Bank of India is the major shareholder, followed by State Bank. Now it is registered as an NBFC with the RBI. Apart from this, you can see that it is also one of the leading primary dealers in the country. And not only is it active in the money market, in the capital market, but it is also active in the derivative segment of the market, dealing in interest rate swaps also. Okay. After that, the name of STCI was changed to STCI Finance Limited, and it is dealing in different segments of the market. Now, scope of operations. So, like DFHI, it is trading in government securities, interbank call money market, repo market, derivative segment of market. Also, this institution is very active. And apart from that, it is also dealing in portfolio management services and distributing mutual fund products. Okay, so repo, reverse repo, all these arrangements, when we are talking about these agreements with respect to banks and commercial banks and RBI. Now, there are other players in the market also who might need funds for short term, that is, say, like call money market for a period of 1 to 14 days, or overnight borrowing lending, or more than 14 days also. So what they can do is, what the financial institutions can do is that they can get short-term funds through the CBLO segment of the market, collateralized borrowing and lending obligations. First, let us read the definition and then I'll explain you. Again, this is collateralized word जहाँ पर आ गया, it means you are giving some collateral. The institutions or the dealers in the market have to offer collateral for getting short-term funds, and this collateral is mostly in form of government securities and treasury bills. So CBLO is a short-term instrument used to borrow or lend for a period. As I told you, it can be overnight lending or it can be for a period more than 1 year also. So it is a simple repo transaction. Okay, but what is happening is the rate of borrowing or lending depends on the demand and supply among the institutions. So it's not fixed by RBI like repo rate is. The rate of borrowing and lending is dependent on the market forces of demand and supply. Now, participants are assigned their borrowing limits on the basis of securities which they are depositing with CCIL. So, this segment of the market is operated by Clearing Corporation of India, and it is counterparty to both the buyers and sellers. Their orders are matched through this platform. Now, CCIL was set up in April 2001, and the negotiated dealing system for participation in this segment of market is Infinite and NDS. So online system, completely transparent system, and that facilitates increase the ease of dealing in securities. You can see who can be members of this segment, which are the institutions that can participate here. You not only have banks, but you also have insurance companies, mutual fund companies, primary dealers, pension funds, who can meet their short term liquidity requirements by participating in the CBLO segment of the market. Okay. So then there is this slide is giving you how auction is taking place. Just for your general awareness, bids can be placed between this duration, and then the orders, buying orders are matched with selling orders and executed through the online trading system.